Hello, I am the Stock Options Hero, and from here on out, I'm going to share with you stock options secrets that only the most successful option traders know. In my videos, you are going to see my secret options trading system that only a handful of people know. And as I'm sure you're well aware of by now, options trading can be very lucrative. However, most options traders are not consistently successful, or even worse, lose money trading stock options. Trading stock options can be a high probability trade if done properly. Let me show you. Now, each day I will record a video where I play simulated options trades. So subscribe to my channel and watch my videos daily to learn how you too can be a successful stock options trader. Disclaimer: these videos are for educational and entertainment purposes only and does not constitute a recommendation to buy or sell any securities or stock options. Before I dive into today's stock options video, I have a small favor to ask. If you like this video or any of my videos, please subscribe to my channel and hit the bell icon so you will see my videos as soon as they are posted. This way, you won't miss out on any paper trading ideas. Tell me in the comments section which option trades you are looking at paper trading, and if you're lucky, I might do analysis on a ticker symbol from the comments section. All right, let's leap into today's video. Welcome to another exciting video of Zero DTE Option Strategy, brought to you by the Stock Options Hero. Oh yeah, let's leap into it. All right, so today's update, we had a pretty solid trade yesterday. It just barely closed out. I had placed the May 16, 4160, 4165 bear call spread the night before. I think I opened it about an hour or two before the close, so technically it was a 1 DTE option spread, but it basically was a 0 DTE because there was hardly any time left in the day before. So I captured $700 on that overnight trade using 5,000 in buying power. So 700 divided by 5,000 is 14%. So I made 14% return on my money overnight. And that is the power of the 0 DTE options strategy. The downside is if there's some significant news announcement that comes out, that could have easily turned into a $5,000 loss. So far, I've been fairly lucky. Now, let me share with you my secret strategy that has been doing so well that I've profited $8,000 year to date. And really, that's not even been a month yet of trading 0 DTE options strategy using my mean reversion component. So let me show you the basics of it. What I like to do is look at the 1 year daily time frame. So I'm already on it right here. So looking at the 1 year daily, SPX is in the upward trend. However, if you zoom in, say to the last 6 months or so, we're still in a pretty strong upward trend. But that being said, SPX is trading close to the mean on the 6 month. What does the 3 month look like? Sorry, that's the 3 year, my bad. 3 month, 1 day. Still pretty strong upward trend. And what I see is the MACD crossing to the downside and the stochastic crossing over, which is a bearish signal, meaning that the price will most likely be heading lower in the short term. So one thing to keep in mind is MACD is a momentum indicator and is a lagging indicator, where the stochastic is more of a faster indicator. So I will place trade entries and exits based off of the 7-3 slow stochastic. And right now, even though we're in an upward trend over the last 3, 6 months, even a year, I still believe that SPX will most likely reverse back down to this previous support level around 40.60, thereabouts. I mean, it's not a perfect trend line, but it gives you an idea. So I'm pretty confident SPX will retrace back down to the 40.60 level. So that being said, I am placing bearish trades on SPX when it rallies intraday. Like, for example, yesterday, let me zoom out. Trying to remember where I got in it. It might be hidden by this reverse. I'm thinking I probably went short either here or around here, and I went way up here. So with bear call and bull put spreads, you want to sell into strength. When you sell into strength, your option premium is more valuable, and chances are the stock or the index has already made its move and hopefully will revert back to the mean. So I'm a huge fan of mean reversion trades. So you can kind of see what I mean if we look at a shorter time frame, like a 5-day, 5-minute. Looking at SPX, overall, it spends most of its time in this middle LRC or linear regression channel, and far less time at the extreme LRC. So this is the mean in the middle, +1 LRC, +2 LRC. This is the -1 LRC, -2 LRC. I think in terms of standard deviations from the mean, so this is a +1 standard deviation, +2 standard deviation, -1 standard deviation, and -2 standard deviation. And invariably, when price touches this +1 or +2 or -2 standard deviation LRC, it usually will snap back towards the mean. And this happens on every time frame I've ever observed. Now, sometimes over a longer time frame, obviously, so if you're looking at a monthly time frame, it takes longer for the price to revert back to the mean. But when you're looking at a 5-day, 5-minute, it will often revert back to the mean within 1 or 2 days. So ideally, when we are putting on these spread trays, we want to wait for the price level to be at the +2 or the -2 standard deviation. But right now, it's trading fairly close to the mean, so it is not an ideal time to put on a trade unless you're thinking of doing like an iron condor up here around like 41.45, 41.50, or 41.05 and 4100. But because it's such a short duration trade, I would much rather wait for SPX to be trading at an extreme price level in the near term. So I generally don't like entering a trade at the mean. I would much rather wait for it to be trading at an extreme price level. So let me use this, since this is a more volatile day. See how it gapped up at the open. Then we had a hard sell-off, so a bearish engulfing candle, reverted, came close to the mean, filled the gap, and then went back to the mean, and it just kind of bounced around. So this is a pretty extreme move day for SPX. It touched both +2 and -2 standard deviations. So if you were watching this throughout the entire day, you could have written a bear call spread on this candle for way up here, and then wrote a bull put spread like around here on this candle for further down here. And if that was the case, that would have been a probably around $1,000 to $1,500 profit on that day, depending on how much capital you used and how many contracts you purchased or sold to open. So that's the biggest downside I see thus far to this SPX strategy is how much time goes into monitoring SPX and where it's trading intraday. Whereas the 45 DTE, you're just looking at the daily time frames and entering based off of the daily candle. So much less analysis intensive, but the trade-off is with more analysis on the SPX. And if you're correct in your assumption, then you are paid more quickly, but you can also be punished more quickly as well if you were incorrect on your assumption of direction. So far, I think of like the, I don't know, like 6 or 7 0 DTE trades I've placed. I've only had 1 loss. So far it's pretty good. And ideally, once again, here maybe if we switch to a 10-day, 10-minute, we'd want to wait for SPX to be trading at the extremes of these. Now, if you're waiting for it to trade at the +2 or -2 on the 10-minute, you only have had 1 trade, basically, in the last 10 days. So that's why it may make more sense to trade off of the 5-day 5-minute, because we have 1 trade, 2 trades, 3 trades, 4 trades, 5 trades, 6 trades basically in the last 10 days. Now, you could use these as your entries, or you could use the +1, -1, right? But to be more conservative, if you're trading a larger account and you want to have a higher probability of success, because lately I've been trading $5,000 per trade. So if it goes wrong, that's a 5% loss in a $100,000 account. So if you're trading one contract, you could try placing the spread based off the +1, -1 LRC. See how that works out for you, because it generally prefers to stay closer to the mean, so it may work out for you. So, and that's where you need to practice paper trading this strategy to figure out your risk tolerance and then write rules and follow them until you have a very good reason to modify them. But you should not modify your trading rules during a trade, right? You should stick to your existing trading rules when you're in a trade. Unless usually when I modify my existing trades in my existing rules in a current trade, it ends up being a losing trade. So I've learned from experience to follow your rules. That's why you have your rules created in the first place. It's like driving around without a seatbelt. Seatbelts are helpful. It's more constrictive, and it feels more freeing not being tethered to a seatbelt, but when you get into that accident, you're sure grateful that you had it buckled, right? So, yeah. Anyway, so I have an open order, and I don't think I got filled on it. Did I? Yeah, no, it's still working. Now, I wanted 45 cents. It's trading at 35 cents. I'm not going to chase it. If it doesn't fill today, I'll look for another entry tomorrow. But with it selling off, most likely won't get filled before the close, but that's all right. I had a good return so far, $700 day, just holding overnight. So I'm not going to force the trade. I'm going to let the trade come to me, and when it makes sense, then I will pull the trigger, but not before. So that's it for the day. Thanks for watching. Make sure you subscribe and comment below on any trades that you've been doing in the past week, or any comments on how I might improve this 0 DTE options strategy. More than happy to hear what you have to say. Thanks again, and happy trading.